The stock market is crashing, and if we look at the heat map of the S&P 500, we can see red pretty much everywhere. We have Amazon down over 4%, Apple down 4%, Microsoft down 2.5%, Nvidia down around 6.5%. Pretty much everywhere we look, we can see companies in the red. Now, this was sparked by last night. Japan just had their worst day in the market since 1987. And if we look at my personal portfolio, I'm currently down around $5,000 on the day, with my portfolio value now sitting at about $189,500, but to be fair, I'm still up around 25% in total. Now, if you're watching the news today, you're seeing pretty bearish headlines everywhere you look, and to be fair, it makes sense. This is a massive sell-off in the market. We haven't seen anything like this in quite some time, at least since the 2020 crash. So for a lot of people, this is a pretty scary event. You're seeing your portfolio value drop by a large amount, maybe the largest you've ever seen. And you may be wondering, how can I prepare for a full-on market crash? Well, I'm here to bring you good news. This event should not be nearly as scary as the media would lead you to believe if you take the right approach. In fact, if you're a long-term investor, or even better, you're a long-term dividend growth investor, this is really good news. So in this video, I want to explain why this is such good news and how in a worst-case scenario, you can prepare for a lost decade of investing. So let's go ahead and jump into it. Now, this is something I was talking about on Twitter earlier this morning. The first thing we have to understand, whenever we see a huge sell-off in the market, there's a huge difference in high-quality stocks selling off versus low-quality stocks selling off during a bear market. We have to understand, yes, the share price for both of these types of stock are going to fall pretty dramatically during a bear market. Again, if we jump over to the S&P 500, we see Apple now down 4.27%, Microsoft down 2.56%. If we come over here and look at some of these lower quality companies that aren't as good as Microsoft and Apple, for example, if we look at utilities, we can see some of these stocks are pretty heavily in the red as well. But here's the major key difference that we have to understand. For high quality companies, oftentimes the underlying fundamentals don't deteriorate during a bear market, but for lower quality companies, the fundamentals often do deteriorate. This creates opportunity to buy high quality companies, but it creates the illusion of opportunity to buy low quality companies. Some low quality companies never fully recover from bear markets. Meanwhile, buying higher quality companies during bear markets can often lead to amazing results. Now let's look at an example of this. If we jump over to my stock screener, again, you can download any of my spreadsheets on tickerdata.com, link in the description. But let's look at an example and let's compare Apple stock versus AT&T stock over the past decade. For example, 2020, that was a huge year where the market crashed. Let's look at what happened to the fundamentals with Apple during this time. We can see all this data will load in, and the first thing you'll notice is if we look at revenue per share, the top line of the income statement, how much money is coming into the business. 2020 really wasn't a bad year for the company. In fact, revenue per share was sitting at $15.82. In the previous year, it was sitting at $14.09. So even though we saw a major decline in the market in 2020, the revenue per share for this company still increased. We jump over to the profitability and income statement sheet. Again, we can see revenue in 2019 was sitting at $260 billion, and in 2020, it jumped up to $274.5 billion. So even though there was a huge sell-off of Apple stock during this time period, the fundamentals didn't deteriorate, and in fact, they got even better. If we look at free cash flow per share, we can see the same remained true there. The same is true with earnings per share. They continued to buy back their stock, and their return on invested capital in 2020 was as high as 30%. If we look at the gross profit ratio in 2020, it was sitting at about 38.23%, which is pretty close to that 10-year average for the company. So the fundamentals of Apple didn't deteriorate during this time, they got even better, and this led to a huge buying opportunity. If we look at Apple during this time, we can see they sold off more than 25%. They were as high as around $81.30 per share and dropped all the way down to around $60 per share. That is a massive sell-off. Now let's compare this to a lower quality company, AT&T. We'll plug in stock ticker T, and we start to see a different picture. Look here, AT&T during 2020. For the first time in quite some time, they had a year where the earnings per share for the company was negative, came in at negative 0.72. We can see the bottom line, revenue per share, actually declined a little bit, coming in at about $24 per share when the previous year is $24.76 per share. Return on invested capital was pretty weak as well, coming in at about 2.51%. Again, keep in mind, return on invested capital, this is a measure of how profitable are the projects the company is investing into. So that's not very good. If we look at the profitability spreadsheet, again, we can see organic revenue, 2019 sitting at $181 billion, and in 2020, $171 billion. So during this market decline, we saw a lot of the fundamentals for AT&T deteriorate. And if we jump over to Seeking Alpha and look at them over the past 5 years, here's where they are after the 2020 market crash, down to around $21.21 per share. The company has since never recovered to those levels. We can see for a short period of time in 2021, it did bounce back up, but pretty much the long-term stories, it's continued to go lower and lower. Those fundamentals have continued to deteriorate during this time. So when you're looking at this sell-off and you're looking for opportunities, you have to understand, are the underlying fundamentals of the companies I'm interested in changing? If they're not changing or getting even better, it creates an incredible buying opportunity. But if the fundamentals are deteriorating, then you'll probably see that share price continue to go even lower in the coming years. And so while there's panic in the market, this is actually something I just tweeted about earlier today. If your favorite store discounted their products at 20%, everyone would be rushing to buy. But if the stock market is discounted at 20%, people run away. And this is the exact reason many people will never be successful investors. Now, to be fair, we saw a pretty quick turnaround after the 2020 crash. Again, the market hit all-time highs fairly quickly after that time. But historically speaking, this hasn't always been the case. And in fact, from 2000 to around 2010, 2011, we had what's known as the lost decade of investing. We can see during 2000, SPY, this represents the S&P 500. It got as high as around $150 per share. And if we move forward all the way to around 2007, 2008, it got back to those levels. So it took around 8 years for the market to recover, and then we had another crash, and it wasn't until around 2013 that the market got back to those 2000 levels. This is what's known as the lost decade of investing. How can we prepare for a time period like this? This was a really devastating financial time for a lot of people, especially if you were close to retirement age and you were planning on selling shares in your portfolio in order to fund your retirement. And ironically enough, I sent out a newsletter just a few weeks ago on how you could prepare for a lost decade of investing. If you haven't signed up for my free weekly newsletter, you can do so at the link in the description. But in this newsletter, I pointed out the exact same thing I just mentioned. S&P 500 in the year 2000, around 1,500. 10 years later, it's sitting at about 1,100. That's an entire decade of pretty much no gains, and it's easy to see why people would call this the lost decade. If you owned stocks during this time period that didn't pay any dividends, you had absolutely no returns. In fact, you probably saw negative returns like most people. But if you did own stocks that paid dividends, a few different things could have happened. Number one, you received income from your investments to help supplement your own income. There was a lot of layoffs during this time period, so if you had some passive income coming in from dividend stocks, that was probably a huge help to your financial health. But here's the second thing that could have happened, and I think this is the best case scenario. You were able to reinvest your dividends, increasing your annual dividend income. Now, we'll come back to this second point in just a moment because that's what I'm actually doing right now. But if we look at this first point, you have to understand, people who were living off their passive dividend income during this time period probably looked like geniuses during this time period. Their ability to retire was not reliant on market conditions. This is a key concept you have to understand. The market crashing during this time period prevented a lot of people from retiring when they wanted to because they were reliant on market conditions. But if you were planning on living off dividend income during this time period, then market conditions didn't determine when you got to retire. So again, people receiving dividend income during this time period were not reliant on market conditions. And then we go back to category number 2, which is what I'm currently doing. I'm reinvesting my dividends, increasing my annual dividend income. Let's talk about what happened to these people for a moment. If we scroll down, we can see, yes, they probably didn't see much capital appreciation during this time period, but to be fair, no group of people did. But here's the big difference. They were able to continue to increase their annual dividend income every single year by reinvesting their dividends. And if they were wise with their investments, they also saw their stocks increase their dividend payouts over time. So their passive income grew every single year for those reasons. Despite the market value of their portfolio going really down, their annual dividend income continued to climb higher and higher. So the intelligent dividend investor was able to sleep well at night, knowing their payments were still coming in and even growing. And we can see a great example of this with my personal portfolio. If we jump over to my dividend dashboard and look at my projected annual dividend income chart, if we go ahead and zoom in and look at this, we'll scroll down. Here's what we can see. I'll blow this chart up a little bit. Every single month, my projected annual dividend income continues to climb higher and higher. And keep in mind, during this time period, we've obviously had months where we've seen huge market declines. For example, October of 22, the market declined by quite a bit. The same was true in October of 2023. We saw a large market decline. But during these time periods, my projected annual dividend income continued to increase every single month. And again, this is a concept I tweeted about earlier today. Follow me over on Twitter/X if you don't already. While yes, my portfolio is down over $5,000 today, my annual dividend income did not drop a single dollar. And in fact, it's actually good news that my portfolio is down because I can buy more stocks and get more dividend income. I can reinvest my dividends and buy even more shares, in turn getting me even more dividend income. The stocks that I hold can buy back shares at more attractive rates, again, giving them more ability to pay out bigger dividend payments. So if you're investing for the long term, or even better, a long-term dividend growth investor, You don't really have to worry about a lost decade of investing. You don't have to worry about market crashes where pretty much everywhere you look in the S&P 500, the market is red. When you buy high quality companies that are constantly increasing the amount they pay out in dividends, you can sleep well at night despite market conditions. This is one of the biggest benefits of dividend investing. So when I wake up in the morning and I see news like this, Japan having its worst day since 1987, I look at the stock market, I see that everywhere in the S&P 500, the market is down. When I look at my personal portfolio and see that I'm down by about $5,000 on the day, none of this really has to bother me because I'm looking at my projected annual dividend income over time. This number continues to climb higher and higher. My ability to one day live off dividends is not reliant on current market conditions. So seeing this heat map doesn't concern me, it excites me. I love being able to buy high quality companies at good valuations. So go ahead and let me know in the comments down below what you think of the stock market crash that's currently going on. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. But with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.